Hello everyone, my name is Judith Fiander, CEO of Australian Philanthropic Services, and I'd like to welcome you to the Australian Philanthropic Services Foundation Investment Update. I'd like to acknowledge the traditional owners of the land on which I am currently working, the Gadigal people of the Eora Nation. People are joining this webinar from all over, so let me include in my acknowledgement the traditional owners of wherever you are joining us from today. I acknowledge the elders past and present of First Nations people all across the country, and I include in that the new generation of emerging First Nations leaders. And I thank them for their ongoing custodial relationship with the lands and waters on which we are all fortunate to live in Australia. Welcome again, and thank you for attending. This is the first one of these that we have held in this format. And we have speakers spread across the country. So let me say right now, if the tech lets us down, as tech has done for large chunks of the planet during this week, we do have plans B, C, and D, but let's hope for smooth sailing. So we'll get stuck in. For those attending who don't know APS so well, let me briefly tell you that since inception, Australian Philanthropic Services has grown from a small speck on the philanthropic landscape to being the leading philanthropic services provider in Australia. I know that sounds awfully boastful, but here's the thing. When we talk about big and growing numbers at APS, what we're really talking about is the generosity of our clients. It's your giving that makes up the numbers, and it's your giving plus the giving of another 1,000 APS clients that resulted in 242 million going to 2,660 different charities in FY 2025. That is from all APS clients. So it's from APS Foundation clients together with our 360 private ancillary fund clients, which of course have their own individual investment strategies and their own investment managers, some of whom are joining us online today. So welcome to you too. But today we are going to hear about the investment of the 453 million, as at the end of August, sitting within APS Foundation. That 453 million makes APS Foundation the fastest growing and the most generous public ancillary fund of its type in the country. Part of its secret sauce is the fact that we are a charitable offering, not a for-profit company. Part of it is the excellent portal and team making it simple for donors, and part of it is the investment approach. Our two excellent speakers today are going to talk about the respective APS Foundation portfolios they manage. They will each speak for about 20 minutes, and if all goes to plan, that should allow for about 10 minutes of questions, which some of you have kindly submitted prior to today. But you are welcome to submit them in the chat, and we'll get to as many as we possibly can. So now, to say some nice things about the speakers and provide the investment context for APS Foundation, I'd like to introduce the chairman of APS Foundation, Mr. David Ward. David was one of the founding directors of Australian Philanthropic Services. He worked in banking for nearly 20 years before moving into the philanthropy sector. In that time, he held senior positions at ANZ, including Chief Economist in New Zealand and General Manager Investor Relations. He also spent 4 years as Managing Director of ANZ Trustees, which administered over 200 charitable trusts. David sat on the Council of Philanthropy Australia for a decade and is considered a leading authority on ancillary funds. He's written 3 trustee handbooks for Philanthropy Australia, including the Private Ancillary Fund Handbook in its 3rd edition now, I think. He's conducted Philanthropy Australia's governance seminars, lectured at Swinburne University as part of their Asia Pacific Centre for Social Investment and Philanthropy, and David was also a member of the International Panel on the Code of Conduct for Endowed Foundations for the CFA Institute. He is also our shining star as APS Technical Director and provides professional development to APS staff throughout the year, each and every year. He's made a huge contribution to APS overall and to APS Foundation in his role as chair. So David, I will hand over to you now.
Thank you, Jude, and Good afternoon, everybody. While many on the call are familiar with the structure of APS Foundation, particularly for those of you who are not, a quick recap. APS Foundation is a turnkey solution for engaging in philanthropy. It's a registered charity and it's a DGR item 2, allowing giving fund holders to get tax deductibility for their donations. Individuals contribute their giving to their giving fund and recommend charities to be supported from that fund. In the meantime, all the funds are collectively invested together. It is that investment aspect that we're focusing on today. APS Foundation started in May 2012, at the same time that APS, or just after APS formally launched, with 4 giving funds and $1 million. As Jude said, at the end of August, it has now got 731 giving funds and $453 million committed to supporting the community. We're extremely proud of this achievement, even more so of the 117 million of funds that have been granted out from the foundation to community charities over that 13 years. And while ongoing donations from new and existing giving fund holders has been the driver for this growth, outstanding investment performance, 10% per annum compounding, has also been a significant factor, including as part of the reason why new giving fund holders have chosen to join APS Foundation. APS Foundation is a perpetual foundation, so its decisions can be truly long-term. And this long-term investment horizon and the strong capital inflows each year, particularly in May and June, means we can patiently invest, including in prospectively, ultimately very good returning, but currently illiquid opportunities. Not only do donors get a personal tax deduction on their donations, but the earnings inside APS Foundation are tax-free, there's no CGT, and franking credits attached to Australian company dividends are refundable from the ATO. While we do charge fees to cover costs, APS is a charity. We started with a low 1.025% fee for the foundation and have kept that throughout this period. Pro bono and low bono services from some of our investment partners help in this regard to keeping fees low, and we thank them for that support. Particularly because of the respected position of our 2 investment managers have in the investment community and APS Foundation's increasing size, the portfolio has access to investments not generally available to the public, which you will hear about today. The investment strategy for the entire foundation, next slide please, Sharon, for the entire foundation is to achieve a return of CPI plus 4% on a rolling 7-year basis. CPI, so the real value of the funds in the foundation is maintained, plus 4% is that is the mandated minimum annual distribution from public ancillary funds. Although currently, as a result of the enormous generosity of giving fund holders during COVID, when the foundation granted out a lot more than its 4%, over 11% in 1 year, we actually qualified for a government incentive which reduced the forward minimum distribution to 3%, with the current financial year being the last year of that 3% minimum distribution. The rolling 7 years is the long-term perspective and acknowledges that we are not overly concerned with short-term volatility of the portfolio. APS Foundation has 1 investment strategy with 2 general portfolios. With 2 portfolios. The general portfolio since 2012, and from 2022, the focus portfolio with an enhanced ESG lens. We are fortunate to have two extremely experienced investment professionals managing APS Foundation funds. They will both present today. So let me briefly introduce Chris Cuffe and David Wright. David will then speak, immediately followed by Chris. Chris Cuffe AO is Chairman and Founder of Australian Philanthropic Services. He has been the Portfolio Manager of APS Foundation's General Portfolio since the inception. Chris is an investment industry legend, from building Colonial First State from a startup operation in the late 1980s to becoming Australia's largest investment manager over a 14-year period. He is now involved in a number of directorships and investment committees. He's an investment committee member of UniSuper, a $125 billion super fund. He's the founding director and portfolio manager of Third Link Growth Fund, chairman of Hearts and Minds Limited, and a non-executive director of Global Value Fund, and yesterday stepped down as a director of Argo Investment Limited. He's on the investment committee of the largest foundation in Australia, the Paul Ramsay Foundation. Chris is a fellow of the Institute of Chartered Accountants and also a fellow of the Institute of Company Directors. In 2007, Chris was inducted into the Australian Fund Managers IBS Hall of Fame, and he received an Order of Australia in 2017. David Wright is the portfolio manager of APS's Focus portfolio. David is the co-founder and former CEO and investment director of Zenith Investment Partners, a leading provider of independent research and portfolio construction advice. He has also a wealth of investment experience, including as head of research at IWL, an associate director and head of managed funds research at Lonsdale Limited. David is also a director and chairman of the investment committee of ASX-listed Hearts and Minds Investments, a member of the Qantas Superannuation Investment Committee, and the Deakin University Financial Planning Advisory Board. Over to you, David.
Thank you very much, David and Jude, and welcome everybody. Good afternoon, and thanks very much for joining. So as David said, it's my role today to provide you with a brief update of what's been happening with the Focus portfolio. And I'll start with a very high-level market overview. I mean, who would have thought, everybody, that, you know, with tariff threats, inflation, interest rate uncertainty, geopolitical tensions through the world, that we would now have the investment markets shrugging all that off to generate a return so far this year for the S&P of around 14%. That's year to date, and we've got the Australian market, the ASX 200, over 10%. So the markets continue to plough on regardless of those uncertainties. I mean, confidence has returned, given that interest rates clearly peaked, a little while ago, and we've started to see interest rate cuts by both the Reserve Bank and the Federal Reserve in particular in the US, albeit those interest rate cuts have been sort of pushed out than what they first were forecast, and have been less than what people and investors had anticipated. But certainly interest rates have peaked and are now on the way down. Just how low they go is likely to be at a smaller magnitude than what was already thought. The artificial intelligence and technology sectors have really been, the heroes, I guess, of those share market gains. The Magnificent Seven, as they're called in the US, the sort of US mega capitalization or large companies in the technology space, household names, most of them, have really performed very, very strongly from a share perspective, and to be fair, profitability, but have reached levels now where, on any sort of metric are fully valued too expensive. And this has created some concentration risk in global portfolios, and we'll talk a little about that in terms of the need for diversification through this period of uncertainty in investment markets. Bond markets have stabilised really as a result of interest rates having peaked and now official cash rates on the way down. And it has provided some income opportunities after a period at which, bond yields were at record low levels. And so the income generation from bonds for a long period of time was really not really worth the risk. And the issue and growth in the green and sustainable sort of linked bonds has been encouraging, certainly for the investment options in the focused portfolio. So what's been happening, thanks Sharon, on the next one, from an ESG and responsible investment perspective on the trends and thematics front that is and will impact the ability of the focused portfolio to continue to generate good returns. I guess, certainly with the election of Trump in the US, a lot of people tap the brake on ESG, responsible investment and sustainability, given that his focus, or at least the Trump administration's focus, was not as strong as previously was from an ESG and responsible investment perspective. So we have, though, seen some confidence returning to the sector, with money flowing back into ESG, responsible investment and sustainable funds through to the mid, 2025, showing that there is investor confidence rebuilding again. Particularly in Europe, ESG, responsible investment, the move to clean energy is a very strong thematic. And in the sort of underneath in the blue square there, clean energy investment, as an example, hit record high levels this year. So notwithstanding the less focus by the Trump administration, bear in mind, everyone, that a number of those projects were well and truly underway prior to his election. And so they weren't going to be backed out. And very important for kind of highly populated areas, obviously China being the major one, where electric vehicles, and we're seeing it here, aren't we, in terms of the number of Chinese-made electric vehicles hitting the market, very important for their environment and quality of air. So we've seen, certainly clean energy investment hit record levels. Sustainable bond issuance, and we're talking now about, predominantly governments issuing bonds in, social infrastructure, renewable projects, climate adaptation. So with that, we've seen evolution and certainly maturity in green bonds and green bond funds, and a number of options for the focus portfolio to invest in or consider investing in. It is, however, the progress across regions, as I've already alluded to, in terms of the strength, in particular in Europe, not quite as strong here in Australia, but certainly stronger than the US. And in the US, as I said, have really probably tapped the brake a little bit since the Trump election. So we do need to be selective in terms of which investments, regions, sectors in which we're investing in with the focus portfolio. The following chart really illustrates that the regulatory and policy developments are a huge influencer on the prospects of ESG, responsible investment and sustainability investing. And they certainly have become more stringent. So I think in the Australian Financial Review, even this morning, there's a story about the Australian government potentially looking to issue regulation around environmental impact and reporting by some of the largest ASX companies. So in the US, even the security exchange's climate disclosure rules have faced legal challenges, creating some uncertainty there. However, in Europe, new corporate reporting standards the acronym being sort of the CSRD, which stands for Corporate Sustainability Reporting Directive, is really about, companies in not only their financial reporting need to provide greater reporting on environmental impact. Carbon emissions would be probably the obvious example there. And that sort of regulation is coming to the Australian market and companies listed on the exchange here as well. The flip side of that in the other side of the chart there is really the greenwashing enforcement is now very serious. So, you would have perhaps seen, some fairly high level and well-known names like Vanguard, like Mercer's, like a couple of the industry super funds have been kind of wrapped over the knuckles by the regulators for presenting information and representing some of their investment options as being, ESG or responsible investment or sustainable, and in fact didn't meet the criteria required for that for that sort of labeling. So that's probably a good point just to emphasize, what we're doing with the focused portfolio is not exclusively an ESG or responsible investment or sustainability option. In fact, at this point, everybody, when you're constructing a diversified portfolio across multi-assets, it still is nearly impossible to construct a portfolio that is, totally green, totally ESG, totally responsible investment. And so it's important to understand, what the portfolios are and what they're not. We are certainly trying to, as David said before, provide another option for you that really is focusing on those managers and investments that play in that space, but not all investments will meet that ESG and responsible investment criteria. Now, so from the focus portfolio update, it has been pleasing. I think, as David mentioned, the portfolio has only launched, we just clicked over 3 years actually. So the portfolio continues to grow. It's now around 42 million in size. It's performed in line with expectations. We do have a high cash weighting, and bear in mind, that the cash, this has been through the establishment of the portfolio that takes time. So you do tend to have a high cash weighting as that occurs. And thanks to those of you that have supported the portfolio, we had a strong inflow of new monies invested in the portfolio just prior to the end of the last financial year and giving period. So that's really fantastic, and we'll be deploying that cash, which I'll touch on in a moment. The portfolio is well positioned to capture the longer term thematics we've just spoken about, some of which we've just spoken about, clean energy, sustainability, improved company governance and climate reporting, through managers like, Ausbil, Janus Henderson, Alfinity, Maple Brown Abbott in the infrastructure space. It is a highly diversified portfolio. And there are new investment opportunities for the portfolio that are emerging as the whole sort of sector, as I said, matures. From a portfolio returns perspective, and many of you hopefully would have read the June 30 reporting. So as I said, I'm pleased to report we now have a 3-year track record for the focused portfolio. So that's running at about 8.2% per annum. As David said, the target for the portfolio is CPI +4. So at the moment, that's comfortably being achieved. And as I said, there's been somewhat of a cash drag because we've built up cash. We've been deploying that slowly. So sort of with markets, having performed so strongly and some stocks being expensive, we've used an averaging in type approach for the deployment of the cash, and that'll continue as well as the investment in new opportunities. From an asset allocation perspective, thanks Sharon, on the next. You think of this portfolio as certainly a growth portfolio. It's around an 80-20 portfolio, so 80% being in growth assets of domestic equities, international equities, things like infrastructure, and we'll be looking increasingly at sort of private type assets. So that'll include things like private equity, private infrastructure, things like royalties and so forth. And so that's the current asset allocation, or around that, certainly at the moment. And then, so what is the plan really for the focused portfolio going forward? So as I mentioned, it is to reduce the heavy cash weighting that you saw in the asset allocation pie chart just a moment ago. You know, how are we doing that? It's really averaging in across the existing investments, which is a great risk management exercise, particularly when markets have run so hard. Increase the private assets exposure. As I said, private equity, direct infrastructure, global private debt is something that we would look at. And I think there's a question around private debt that one of you have submitted. Thank you for that. Royalties funds, those type of things. Green bond funds, I mentioned. You know, we've got more options in that space now, and consider social housing, social infrastructure funds as well. It is important that we continue to monitor the responsible investment and ESG sustainable thematics. They will be a big influence on the portfolio, and we might want to make sure that, you know, we're well positioned to capture the performance and benefits from those exposures. And we're continuing to invest via funds while the portfolio continues to grow and maximise diversification. You know, unlike the general portfolio, Chris's portfolio, we don't have any sort of direct investments yet. That may come as the portfolio grows, but certainly while the portfolio is smaller, we can gain greater diversification through the use of premium managers that we've assessed and rate highly in the space. Look, it's probably a great opportunity just to highlight and thank, you know, our partners in the focused portfolio. You know, these are either managers or service providers that are providing their services at either a pro bono or deeply discount rate, certainly at rates that, again, as David mentioned, people can't access outside of the APS umbrella. So we thank them very much for participating and providing their services at a pro bono or a discounted rate. So with that, I think, as both Jude and David has said, certainly happy to take questions, but I'll hand over to Chris now. Thanks, Chris.
Thank you, David. Well, as David Ward introduced me, Chris Cuffe is my name. I look after the general portfolio. So the general portfolio, as was introduced to, has been going for a long time now, since FY13. So we're into our 16th year, and shown in front of you now is a year-by-year returns of the portfolio. And pleasingly, we finished off FY25, financial year 25 to 30th of June 2025, with a 10.6% return, which was great. And in fact, although year by year is not really what I focus on, it's still pleasing to see the portfolio is not as volatile as many investments that are around. Even if you just plotted the Australian Stock Exchange, for example, year by year, you would see much more volatility than that. Next slide. The return that really matters, though, is the rolling 7 year. And you see the magic of time here, that over rolling 7 year periods, returns become in a much tighter range, and hence why we focus on that. So when I'm investing this portfolio, that 7 year number is always in my head. Of course, some quarters or half year or yearly figures can be all over the place, and as a portfolio manager, it gives you stress. There's no doubt about that. But it's really time is what I'm after here. time's your best friend in the investment market, always has been. And you see there too in the orange, the benchmark, which is the target of what we're aiming at, CPI plus 4%. We've managed to beat that in all cases of rolling 7-year periods. Looking at the asset allocation of the fund, it's very well spread. I have a lot more opportunities available to me than David Wright at this point in time, only because the general portfolio is a whole lot bigger, and it's around 410 million, I think, at the moment, something like that. And it has more, it's got that size, which means it can avail itself of lots of things, but also it can pretty much access all asset classes. So you'll see there a good spread amongst Australian listed stocks, international listed stocks. There's a group there called miscellaneous gross assets. They tend to be stocks of, can be listed, unlisted, all types of things. A good smattering of private equity when you've got a long-term focus that you can legitimately invest against. Like a lot of fund managers will tell you they're long-term, but you know, they're measured all the time on short-term periods. Their compensation, personal compensation, is usually based on short-term periods, so it becomes very tough for them to be long-term investors. But we don't have those issues. So private equities are very good there. And in that interest-bearing securities category, a lot of that is in the private credit area, which I'm very comfortable with. On to the next slide. So we're sometimes asked for more of a helicopter view of the general portfolio, because in the 6 monthly updates that we send out, we talk about new investments in there. And as I look down the list, a lot of them you probably wouldn't have heard of, and it's because they might be a newer one. If you see them a lot, you might think, oh, gee, this is a somewhat strange portfolio. But the general portfolio, so the first question in my mind is always, is it fit for purpose? Has it been constructed with, if you like, a formula in place? And the formula I always use for any investment portfolio is top left-hand corner there. What return are we targeting, and over what time frame? As we've said, 4% per annum over CPI over rolling 7-year period. So we're clear on that. Then we move across and say, well, to get that type of return, what type of strategy do we have to adopt to do that? So what's the science behind getting the return? And we know that clearly to get returns like that, you need to have a fair portion in what would generally be called growth assets. And they're assets that can be quite volatile in the short term, but you're generally owning businesses, whether they're listed or unlisted, and those all take time to blossom, so to speak. So you've got to be able to take a longer term view, otherwise you're going to sweat a lot of volatility. And we say, well, you know, has that worked to date? Certainly the slides I just showed you of the rolling 7-year returns, it appears that it's working to date, so that's great. And of course, I'm always finessing that as the portfolio grows. The portfolio, as Judith said, was $1 million on day one. How you invest $1 million is very different to how you invest $410 million, but the strategy is the same. And very much, if you look at the bottom left there, I sort of have in my mind a term. We run a sort of core and satellite approach, and I put there in brackets, we have heavy lifters, and then a lot of sort of targeted opportunities around the outside. And I call the heavy lifters the mainstream part of the portfolio. That's you know, chunky weighting, so to speak, to Australian listed shares, international listed shares, the fixed interest market. So across the portfolio, there's very well regarded mainstream investments, but we also have, as mentioned quickly already, and you saw in the pie chart of the asset allocation, I also have a number of pretty eclectic, perhaps, opportunities that I find come along from time to time. And I'll talk about those in a second. And of course, for a portfolio to be fit for purpose, returns are one thing, but trying to understand and control risk is another thing. And I'll talk about risk in a few minutes. A lot of people think of risk as just volatility, but there's a lot more to it then. So I'm very, very conscious of controlling risk. So next slide, are our investments unusual? Somebody mentioned the other day, gee, your portfolio looks a little unusual. And I'd say perhaps it's not the look and feel of a typical public charity portfolio, and people have different definitions of what is conservative and what is not. But with a 7-year time frame and the size we have, I believe the portfolio is very appropriate, albeit it could be different to others. There's not a lot of charities that have a portfolio of this size, and very few that would have a time frame that we have. And as David mentioned, the portfolio is strongly growing. There's more money coming in than going out. Many charities would be having to have their portfolios quite short-term oriented, because they never particularly know who's calling on the funds when. But in our portfolio, one of the greatest things to emphasise again is this time frame, the long-term time frame, the rolling 7-year period, allows us to access what's called, it's a bit jargony, but it's called the illiquidity premium. And what that basically means, if you can't sell an particular investment almost immediately and you're sort of locked into it for long periods of time, generally speaking, if all things working properly, you're paid a premium for that, if you like, inconvenience or that lack of liquidity. And over time, studies have shown in the really good illiquid investments, that premium can sort of be around 4 or 5% above what you'd expect to get in normal markets. But you only want to be going into those investments if you've got time on your side. And certainly, as mentioned before by David Ward, we have fantastic contacts. I'd say, I've hung around the industry a while. David Ward called me a veteran. Makes me sound like I've got a walking stick. I think that just means I've been in the industry a long time. And because of that, I know a lot of people, and a lot of opportunities arrive on my desk these days without me having to go too far to look for them. The funds of a size now, there's a number of operators around town that know that we are a source of patient capital and very capable of investing a little bit outside the square if we think things make sense. I've talked in previous in-person updates that we've done. Examples of that, we've made considerable investments, what I call there in brackets BESS loans, that's battery energy storage solution loans, a bit like something that could be in David Wright's portfolio too. We're a big investor in that area and getting very attractive returns for what I believe the risk involved, simply because other institutions find it difficult to know where to put those loans. They don't, I don't need to have neat little boxes. Other institutions often do. Our scale now at 410 million, we get opportunities that others simply can't. There's, at the big end of town, many opportunities. You need multi-million dollars to walk through the door. A very good example right now is I'm reviewing a new infrastructure fund of a major institution who's releasing it. I won't tell you the name of it, but it starts with M and its bank is the second name. But the minimum in that is 10 million. Now, I believe that's a great fund, but 10 million is a lot of money, and most funds would simply not be able to access that. And I see lots of other opportunities too, where the ticket size, as I call it, might be $5 million minimum. And you don't want to invest in those things if they're going to comprise, say, more than 10% of your fund or 20% of your fund. That's simply, you can't do that. And the other thing that can make some of our investments look a little unusual is really just the market. There is a lot of change going on in investment markets over the last decade, and there's a lot more investments available to us now that sort of don't fit in a specific category. They're called alternative assets, whether it be things like private debt or royalty funds. David Wright mentioned we're an investor in royalty funds. We're an investor in a very well-regarded US specialist biotech fund that you just couldn't go in before, and on it goes. So overall, I'd say, yeah, our investments could look a little unusual, but very much, as I've said before, we've got a very much a strong core and great opportunities around. And if we head to the next slide, you know, one of the things, if your portfolio, you've got to look at your portfolio all the time and think about risk. And key, as I said a second ago, risk to me is not volatility. In a general sense, most investment professionals use volatility as a surrogate for risk, and they talk about it rather generally. But risk is a whole lot of things. It's like looking in at a diamond through lots of different prisms. It's not just one. The key risk to me is what is the possibility of not meeting the targeted investment return of CPI plus 4% over rolling 7-year periods. And as I said, time on our side allows us to take a long-term view on securities I've chosen to have in the portfolio. So that also gives us a lot of, it gives me a great deal of satisfaction that I can have a portfolio that is very diversified. I'll come to that in a second, but also recently, David Ward and I and another expert who's on the investment committee for this fund, we do have a formal investment committee given its size, and the three of us on the investment committee reviewed in detail another group to see if it made sense for them to manage any money for us. And they were a group of, I call rocket scientists from the investment industry, and in the end they wrote us a report looking at our portfolios that stood today and looking at the track record since it began, and I think they were quite complimentary, saying that not only was the track record excellent, but the downside management was clear strength. What's downside management? It simply means when markets go down, hopefully we don't go down more than that. And if we're doing things really well, perhaps we go down less than that. And that has been the experience to date. So that has a lot of ticks for a portfolio. But really key is that fourth point there. The key to risk management, in my mind, has always been diversification. We have it in spades in this portfolio. And why is it the key? It's simply because I don't know what's going up or what's going down tomorrow. Plenty of investment professionals might have a crack at that, but I think it's pretty difficult. I don't know. You get a feel for different markets as an investment professional. Are they more likely to go up at this point in time than down? But you just don't know. So you make sure you've spread your money across lots of different things. But the spreading the money is not just, shoot it out there like a spray gun or something. Each investment I look at, each investment I think has to be able to meet that CPI plus 4%. That's how I look at it. They've all got to stand on their own, but collectively, it gives me a lot of comfort that some will be doing better than others at certain points of time. Indeed, some will shoot the lights out while others aren't, and then others have their time in the sun. So really, risk management is pretty important to the whole process. In finishing up my part, I would also like David Wright to thank the supporters of the general portfolio. There's quite a few fund managers shown on your screen now who help this portfolio by managing money. I've approached these people. I want to be in their particular funds or whatever, and they have agreed to do it at a lower rate than they would do for other people. And that's really a sign of respect for Australian Philanthropic Services as a charitable organisation. And that, if you like, the discount many of them give us flows straight through to your accounts. It means your accounts are probably experiencing a better return than they otherwise would because of lower fees. Better returns means more money going to the charitable sector, which is what APS is all about. So that's the end of my portion. I think I hand back to you, Judith, to control the questions.
Thanks very much, Chris, and thanks very much, David, for those presentations. That was absolutely terrific. I do have a number of questions that people submitted before the webinar today, and I invite people who are on the webinar now to pop anything else in the chat if they would like us to get to those. We'll try and get to as many as we can, given the time limitations, but we're doing not too well. So, Chris, you mentioned that you see a lot of investment opportunities, and that because of who you are and your depth of experience and the size of the portfolio now, that you do get a lot of stuff that comes to you. How do you stay on top of all of the opportunities that are out there in the market?
Yeah, it's a very good question, Jude. And my starting point has always been, apart from not all the viewers will know, but I do, amongst this blonde hair, have a bit of grey hair. So I spent a lot of time worrying about things, looking at things. But long ago, I got to realise you cannot be on top of all the investments in the world. As simple as that. So what comes to you, you look at it judiciously based on what's going on at the moment. I mean, simply said, if the portfolio's got no cash at the moment because it's fully invested, well, then if something came to me, I'd have to think, well, what am I going to turf out if I want to put this thing in? So I'm selective, and I guess it's just experience over time too that allows you to look at many things and dismiss them very quickly as well. So you know, I don't spend hours looking at everything, but key though, Jude, is really this area of risk diversification. Again, at certain times, I'm going to be looking more for certain types of investments that I would look less at other times, depending on how the weightings of the portfolio goes. And very key, the last point I'll make is the flows into the fund. Like, there's constant money coming in from the investments, interest, dividends, capital gains. There's money flowing out because of our clients granting to charities. That's what it's all about. But also we get a lot of new donations in each year, particularly in May and June. And so that's the real busy time for me. And then post that, a lot of it is sort of weeding the garden, so to speak. Sometimes there's things that just haven't worked out as I'd like, and other times I think, gee, I'd like a bit more of that. So I'm always sort of playing at the edges, so to speak.
Thanks, Chris. Someone else kindly submitted this question, which I think a lot of people will be interested in hearing. It seems that a lot of commentators believe there is a significant correction coming. Firstly, do you think that's the case? And secondly, are you slowing maybe new investments or intending to hold more cash over a period of time to try and prepare? Or
yeah, well, first of all, trying to predict corrections is a tough game, and I don't engage in it. It's a bit like if you've got a clock on the wall and it's busted, well, it will be right twice a day, but the rest of the time it won't be. And you can spend a lot of time trying to guess things in investment markets that are just impossible to guess. And look, there could be, when we say corrections, well, that sort of sounds like everything corrects together, but I can tell you all asset classes generally don't correct together. They can in really stressful times, like the global financial crisis. For short periods of time, almost all asset classes went down, but very quickly, quite a number of them recovered too. So no, I don't sort of have regard to, is there a correction tomorrow or not? I might, though, if I've got marginal new money coming in, I might think, gee, I'm feeling like markets, say, if I'm talking about listed equity markets, are more overvalued than usual, or if I feel they're sort of foolish, I might say, okay, this marginal dollar, I'll put in something that's less sort of prone to what's going to happen in that market. Or right now, everybody's saying the Magnificent Seven investments. I'm sure many people online have heard of those. There's a lot of money pouring into those, and some people say it's ridiculous. But quite honestly, I have no idea what's going to happen with AI and you know, the direction of those companies. All I know is they're extraordinarily profitable and growing at a great great rate. So, but look, the main thing is we've got to invest the money. We can't sit there and have cash in the bank at earning next to nothing. We've got to invest the money, and you take volatility on the chin, and time is your friend again. Rolling 7-year periods allows us to sleep. It should allow us to sleep at night, even in volatile times.
Thank you. David Wright, here's a couple of questions for you from people. There are a growing number of ESG or responsible investment sustainable funds now in the market, but have mainstream fund managers also improved their ESG and responsible investment or sustainable processes for investing?
Yeah, thanks, Judith. That's a good question, actually. And the answer is that they have. So the whole industry has lifted in terms of the focus on environmental and social in particular. To be honest, for as long as probably I've been in the industry, 30 odd years, if you weren't a fund manager focusing heavily on governance issues, then you were kind of net nowhere. So that the real, of course, that's continued to evolve and improve, but the real areas that have, evolved quickly and continue to are in the environmental and social aspect. So you're right. There's dedicated fund managers that have focused and continue to focus on those areas. Will they stay ahead of the pack? As a result of that focus. Probably, but the whole tide has been lifted across the industry, and again, like governance, when institutional investors and research groups like Zenith that I was previously part of are looking at managers, that's a key assessment criteria of what are they doing in relation to their selection of companies and investments. And their assessment and focus on, environmental and social as well as the governance aspect. So yes, it's improved across the board.
Thanks, David. You mentioned during your presentation that so far the focus portfolio is invested via fund managers, and for the very good reason that relates to size rather than direct investments. So if we shifted forward another few years and thought about what the portfolio might look like then, what is the kind of size of the portfolio that would mean you could be looking at more direct investments? And when you started to do that looking, where would you look first?
Yeah, again, good question. While we've been establishing the portfolio, we have felt that the optimal avenue is investing via funds and fund managers. Why is that? Because we're able to have exposure to much greater diversification. So each of these portfolio managers in their own right has either a concentrated, and even a concentrated portfolio will exist of probably 30 stocks, or a more diversified portfolio. So when we're combining them together, and that's the other important consideration, we're combining or trying to combine managers that complement each other. So that'll certainly be, I think, the strategy for the foreseeable future. As Chris mentioned, there are investments in the general portfolio that could easily also be investments in the focus portfolio, kind of meeting the criteria. And it's hard to say at what point would we start doing that, because again, as Chris mentioned, some of these offers are in chunky allocations. So, I think Chris used an example of one that, you need a minimum of 10 million investment. So we wouldn't do that anytime soon in the focus portfolio, because it would become too concentrated and too bigger exposure in the focus portfolio. So it's a good question. It's a hard one to answer. I do think, perhaps from, 100 million, 150 million onwards, that would give us a lot more latitude to potentially invest in direct or individual investments, and maybe Judith, some of those opportunities might be in a kind of, let's call it maybe it's a social housing project, or a direct sort of green bond issue. Those are the types of things that I think will come to us, or already do come to us. But as Chris has mentioned, that could be considered for the focus portfolio going forward.
Thanks, David. I think you've just issued us a challenge there. We're going to need to go and find 100 million so you can
exactly
start to work in a different space. David Ward, if you don't mind, I'm going to throw a couple of questions at you as well while we have you here. As chair of APS Foundation, can I ask you this? These gentlemen both do a great job, and I thank them for their efforts. But what happens if one of them were to, and I'm sorry to say this in public forum, but what if one of them dies or becomes incapacitated in some way? What do you?
I'm not sure, Jude, where it's thanks for that question, but certainly, and as Melbourne people, we say, what happens if someone goes under a tram? Well, of course, Sydney and Brisbane have now got that question of trams as well. But it is something we do think about. You obviously have to, given the key role that both Chris and David play. But firstly, the setting up of the second portfolio in 2022 started to diversify the way the funds are being managed within the overall foundation. We've also now formalised, as Chris mentioned, an investment committee for the general portfolio that's got an outside advisor as well. And so it is really something that we are thinking about and slowly building up that component of the way the overall portfolio is managed, but particularly given most of the underlying investments are in managed funds, that does reduce some of that risk, but it is something that succession planning of investment managers, we know we have to work on.
Thank you, David. And lastly, if you could give us 1 minute, because it's coming up towards 1 o'clock, but this is one of the questions that was submitted beforehand, and that is, what about the changes that are being proposed by Treasury for structured giving? Will that hurt APS Foundation or perhaps?
Just briefly, so the changes that came or have been recommended by the Productivity Commission was that all ancillary funds should have the same minimum distribution requirement, and that requirement should be somewhere between 5 and 8%. So currently, public ancillary funds are at 4%, as I mentioned earlier. That's likely to move up to 5%, and that will clearly mean APS Foundation has 5% a minimum. But when we look back, to say, take the last 4 years, APS Foundation has given away 10%, 8%, 7%, and 10%. So really, it's not going to curtail the generosity of individuals that we have as giving fund holders. Some may respond to it. So it's not potentially a great impost if it goes to 5%. I think it's much more an issue if the ancillary fund minimum for both private and public go to 6 or 7%, that then is potentially going to put some stress on some of those structures and some of those families. And our recommendation to government is they should spend more time trying to encourage more people to give rather than trying to squeeze funds out of already generous people, because often once they start giving, they're going to give more anyway.
Thanks, David. And that is really all we have time for. But thank you to Chris Cuffe, to David Wright, and to you, David Ward, for your time today. A special thank you to all the investment managers who work with APS that Chris and David Wright have mentioned. Your contribution by offering us your time, pro bono or low bono, contributes to the sustainability and growth of each and every APS Foundation giving fund. APSF clients, a huge thank you to you from me, from all of APS, and from the entire charitable community that you support via your giving funds. I'm going to ask you for one more gift before you go, and that is to use the QR code on the screen and let us know how you found today. It'll take about 30 seconds, and we are considering holding one of these twice yearly when we publish the investment report. So some feedback around its usefulness for you would help us make that decision. Thank you very much to Nikki, Sharon, Pauline and Ben for all the work that went into making this session possible today. And lastly, thank you everyone for attending. Be you APS client, future APS client or investment advisor, please don't hesitate to be in touch with all of us here at APS. I wish you a good afternoon. Thank you.